Devina Mehra, what's your view on this whole GDP, GVA and 7.6 versus 8 debate?
Yeah, it is just a matter of which side you are looking at it. So as you said, the number was far ahead of what was expected, no doubt. And also, if I ask people in this room, you would say things are looking very good. My friends are buying new homes. So when I go to order a new luxury SUV, there is a waiting list. So that's one part of the story. The other part, of course, is that 80 crore Indians need free ration, which shows you what's happening in the bulk of the economy. There was that inequality report recently, which of course showed that 65% of the wealth in the country is with the top 10%. 20 years ago, it was 40%. And at that time, the next 40% had also 40%. So now it is like the top 10% has 65, then the next 40 has something like, maybe 22, and the bottom 50% has something like 13%. So the inequity is increasing. Consumption is my major kind of concern area, because consumption growth is sub 3%. Last time it was this low was 2002-03. So after 20 odd years. So GDP has been running on effectively a single engine, which is the government spending and on infrastructure and otherwise. So we need to broaden that. And some other things like manufacturing, if you look at, again, manufacturing is now 13.5% of the GDP. Last time it was this low was 1969. So, the consumption will grow if employment does well, and some of these indicators, not that great growth in manufacturing, exports, etc., also point towards why employment opportunities are not there. And what also worried me was that the employment figures, if you look at, it is showing higher employment in agriculture. And as page 1 of any economics textbook tells you, that is disguised unemployment, because countries progress when people move from out of agriculture, not into agriculture. So those would be, as I said, the top line is what the top headlines look very good, but if you parse it out, those are the areas you need to work on as a country, and I hope we do work on it and have growth which is sustainable. That's the important part.
I don't know if you saw the HSBC data talking of consumption, because they had a report saying that India's GDP data may actually be understating the consumption growth that's underlying.
You're asking me?
Yeah.
I haven't seen that. I mean, maybe it's a hangover from my sell-side days that I don't look at other people's reports for this kind of thing.
You should.
And I mean, because often there are agendas. I'm not talking about this report in particular. As I said, I haven't seen that. But I mean, those are the figures. And not only that, I mean, I remember in around Diwali time in Mint itself, there was a long story which was actually going around semi-urban and rural areas, and where most shopkeepers said that their sales were not back to pre-COVID levels. I mean, it was an eye-opener for me, and this was also, I mean, it was funny in some senses, because we talk about this only the top end doing well, and that report said that right from jewelry to underwear, the shopkeepers were saying that only the high-end stuff is selling. So it was like
yes, consumption has become quite peculiar in our country at this point.
So which is why for the listed space it might even be a good thing, because they might be catering to the more affluent customer. But right. This, if you look at the economy, it's a different story.
Right. So
I'd just like to add one small thing, that we're talking of 8% and 10% growth, but the only time India grew at 7% for 7 out of 8 years, I think, was 2003 to 10. That's it. So, I mean, it's not very easy. If you look at the history of the world, only China had this 10% sustained for decades on end. South Korea and Taiwan to a lesser extent. So it's not something that's easy to do. So it will take a lot of effort to get there.
Madhavi Puri book has been saying about froth in the markets. Saurav is saying small companies are going like anybody's business. Their profits are shooting. So if the profits are shooting up, you should be investing in them, right? So what's happening really?
So mean, I look at the market in two parts. So one is that the broad indices, etc. So, I mean, all of us have this thing in mind that equity markets give you 15, 16% over a period of time, because that's been since the Sensex started, for example, that's been about the compounding. But on all of us, if I ask everyone in the room, they will say, yes, equity returns are volatile. But what people don't realize is how volatile they are, not just on a 1 or 2 year basis, but on a whole decade basis. So while the average is this 15, 16%, the variation in each decade is very dramatic. So in 1980, if you had put in 100 rupees, in 10 years, you would have got 700 rupees. In 2010, if you had put in 100 rupees, in 10 years, you would have got only 230 rupees. So that whole decade, that 2010 to 20, you compounded only about 8.8% at a time when fixed deposit rates used to be 8%. So you effectively got no excess returns on equity. The reason why I'm giving this data is that when you step back, you see the pattern. So that's why when after 2020, that COVID bottom, the market started going up, I was quite certain that, once it's out of that kind of the thing, there is room to go up. And even now, you are not above the trend line. So the risk of a big crash is when you are above the trend line. You're not even at the trend line. So the mainstream indices, I don't see a lot of risk. Where I do see risk is the frothy part of the market, which is the small cap, micro cap. Of course, SEBI's definition of small cap, mid cap keeps changing, because now they have made it that top 100 stocks, next 250 stocks. So it's not market cap based anymore. I mean, to my mind, you should be super careful with anything below 5,000 crore market cap. We don't even look at anything below 1,000. Between 1 and 5,000 also, we are very, very careful, because investing is a loser's game. You win if you don't lose. So first principle in investing is not to lose big money. And since there are many, many new investors, they do not have that history. And what does history tell us? That in 2008-9, the small cap index fell nearly 80%, 78% to be exact. That index level came back in 2016. And then you had a 1.5 year grand bull run at that time also in small caps. And then again, you had a nearly 2/3 fall, a 65% fall. And I always say, don't forget your school mathematics. When something falls 80%, it will go up 5-fold and you are at 0. Something falls 2/3, it triples, you are still at 0. So a lot of micro cap, small cap managers are here talking about a 50-60% compounding the last 2 or 3 years. But if you go back 5 years, you would find that it had gone down 90%, and that's where you are compounding from. So, and also see, in small caps, coming back to the loser's game stuff, it is like that in small caps, unlike in large caps, you can't manage risk by, for instance, putting stop losses, because when the stocks fall, there is no exit. And while theoretically I'm saying the 2008 index came back in 2016, it was actually a completely different index, because the small cap index churns 18-20% a year. In 5 years, it's a different index. So many of those stocks just go into the great blue yonder. I mean, today only about 4,100 companies trade actively. There were many more companies that have been listed in India. If you go back to the 90s, there were years when there were 1,200 and 1,300 listings. So many of them have vanished into air. So basically, be very careful on the frothy ends of the market. But otherwise, I don't see very big risks where we are today. Most interviews I'm asked that, how do you think the FPI flows will be? And I was there at the beginning. In fact, I resigned from Citibank because the Indian market was open to foreign institutions. So 1993, Dr. Manmohan Singh's budget. But what I found was, and at that time there was not much of domestic institutional money. There was only UTI, LIC, etc. And this was a huge new inflow of money. But 1994 is when the inflow started, this huge amount of money coming in. And 94 to 2003 is the only 9-year period in the Indian index history which gave 0 returns. Even on a month-to-month basis in the beginning, we used to track, and we found there was no correlation between the FII flows and the market direction. In fact, the first month, the FII flows turned negative, the market went up. Now I don't even track it except from the balance of payment perspective. So every time anyone asks me this question, well, how will FII flows be or FPI flows be? And I say that, have you seen whether there's even a correlation, let alone a causation of market moves with that? There is none.
Is it time to sell small caps, Devina?
Yes, certainly. I mean, see, small caps is a very broad segment with many things in it, but you should certainly limit your exposure very much in that and be very careful of where you are invested. In terms of a 1-year index target, I have never given it in my life in 30 years, whether in January or April or the new Samvat. And I got the right word for it only last year in Daniel Kahneman's Noise. He says that this comes under the category of objective ignorance, not just something you don't know, but it is something you can't know. So anybody who gives you an index target, ask them last 10 years what were their projections and what was the reality.
So on that note, we'll conclude this. Please give a whole huge round of applause for our panelists.
Thank you.